Gonna need to change the title on the thumbnail. Just remember that there's a lot more to the first presented fair value gap than I got time to do in this one particular video. I'll explain a little bit as we go on. I want to do this as the first example of what we're talking about with the first presented fair value gap, which is there. For those of you who are not sure of what a fair value gap is, I would assume that's nobody watching this. It's a 3 candle pattern. 1, 2, 3, which in between it has got no wicks and only one side delivery. This is buy side delivery with no sell side. Here you see buy side, sell side, buy side, no fair value. This one, there's fair value here. Okay, that's the principle behind the fair value gap, and this is the first presented one in the afternoon. The afternoon, I mean by UK time. This is the start of the New York session, the New York Open. Now, this first presented gap can sort of like show up on the first candle, second, third, any of these. This one, as it happens, if we switch that on for a second, is just before the macro, which is actually an additional confluence that it is a solid place to enter. So this is a pretty textbook example actually, because you've got the drive up, there's the fair value gap being created, and there are 1, 2 rejections, and that one can't even get anywhere near to it. So once you've got that over there, it's not the be all and end all, but once you've got that over there, you could in theory anywhere here enter a long. Target would be up there, I'll show you why. Stop loss would be below the fair value gap, because if it comes back below the fair value gap, it could switch the other way, which does happen, and that's something slightly different called a reclaimed fair value gap even. So that is 1 to win 4. That's a 1 to 4 risk to reward. And why is that such a good target? Why am I picking that in retrospect? Well, the answer is I'm not. That one was actually bang in line with the London high there, as you see, virtually to the pip. And the London high there would have been, and commonly is the first presented fair value gap, the drawn liquidity. Once you've cleared that there, that high, then this low should be protected. So once you get above there, you'd be quite reasonable to take your risk off and just leave that run. I think I actually got out a little bit early on this one. I didn't run it all the way to the high, but it did complete. So there's example 1. Now, if we go to, let me try and find it for you guys. Mark them up in advance so I could just go over it. And I think is was it back as far as the 15th? It might have been Monday. There we are, 15th. Shame I missed this. The 1 minute time frame won't allow me to go back any further, but the week before this is the Monday of this week. And the previous week, this entry model worked. I think it was either 3 or 4 days I put in the group chat. It was either the 3rd or 4th day that this had panned out. But here you see this is a true first presented fair value gap with no additional confluence. And here you'll see exactly the same pattern again. Okay, the first presented fair value gap is there. Bang. That is actually, if you zoom in really super close, that is a tiny bit off, is it? Let's have a look. Oh, hang on. Beg your pardon. To the mark there, literally to there. That's the actual gap, but same setup, pretty much identical. On this time you've got 1, 2, 3, 4 rejections, goes up, comes down, can come back down as far as there, you know, if you do take a long there, and you know, again, your stop loss would be initially, you could get in any of those candles there. If you missed that one, this is another possibility to enter. Okay, so I just get in that there with the stop loss there. Then once I'm in, what I will do then, if I haven't marked it up previously, which you've seen my charts, normally I will look at where is a potential target. Now in this instance, we're already way above London high, which would have been target, and we're very obviously in a very big uptrend. So target wise on this one, I can't actually show you, but I'm pretty sure that it was a target up here for the week before. So again, you know, you could have run that to there for a 1 to 5 risk reward, or you could have left a runner, even though it pulled back. It did. The sensible thing to do is to get out, you know, somewhere up there when you made a good profit, really, or at least take the bulk of your position off, take the risk off on the remainder of it. And if you wanted to leave a runner, in this case, obviously the runner would have played out up to a maximum of 1 to 9 point, almost 1 to 10. But that there, anywhere there, any 1 to 3, 1 to 4, 1 to 5, anywhere there would have been a nice result in anybody's book. And lastly, for this particular video, I think I'm going to have to redo a couple of these. Maybe splice them together. We've got the example from this one from Thursday the 25th. So this was yesterday, wasn't it? Yeah, yesterday. So this one is another thing that can happen. I actually took 2 trades off this because initially we're going to have to cover AMD or point of 3, power of 3 at some point as well, guys. But initially I was expecting a push up and then a crash down, purely because we had this massive move up out of nowhere on the Wednesday. So there's a likelihood, high probability, that at least this is going to correct to at least 50%. So that was within the back of my mind, and then we get a very similar thing happen here. Slightly different. This isn't quite as textbook, making it hard for myself. Purely because we didn't really come back for retest. Open up, swung up in the first instance, then pushed down with a lot of force. So the first target I'd have in mind there would be the Asia lows, right? Once you're coming down past the London lows there, I think I got out initially at the Asia lows, which was here, right? That was my first trade. Now if we map that out, and I went risk off in this one really quickly because it was pretty obvious it was going to forcefully drop, you know. So short in this instance from, I think it was around about here I got in, and again you're still going to put the top stop loss in a sensible place, and that was my target. So this one initially gave me roughly a 1 to 3 or 3.5 ish. Okay, risk off very early, so there's you know, no danger of losing anything. Like that was actually set as my stop loss. But when I saw this crashing through here, what you've got here is really strong impulses, and sellers are obviously in control there. And there was another target down here, right? Which I thought, well, if it's going to drop all the way down there. So I took a second short. I think it was around here. I trailed the stop really tight on that one because I didn't want to mess about, and called this one live as well in the chat, and that was a 1 to 11. Now it didn't get all the way down there, and this is an interesting point on this as well in terms of targets and draws and liquidity. At this point, I think it was around about here somewhere, it was in the group chart anyway, it took off about 80%. And let this run as a runner. Left one running. And when it started to pull back here, and NASA's got a nasty habit of doing this, is leaving the last little bit. And I think I got out here because I was happy with what I'd you know, had already. There's no reason to push it. That would have been the perfect stop there for a different reason, but I missed that. And this box then becomes engineered sell side liquidity, where almost gone to target, pulled away and gone off the other way. So this I was watching, keeping a little eye on all the way through the day on Thursday, and I was expecting it, if I'm honest, to come back down and smash this as well. Didn't happen, so closed up shop, went to bed, and then Asia, if you look what Asia did, came down and actually completed the move. So yeah, there's a lot to be learned off those particular trades there. I mean, obviously this one was a bit of a freak of nature. You don't normally get this, but you don't normally get this either. So that was a big massive clue there. Did get out a bit early in that one, but that one was safe, 1 to 3. On this one I think I ended up with sort of a 1 to 4 or 1 to 5 initially, and then the runner was in profit and I got out about there when that started pulling back on that one. So amazing day. There is one for today as well, but it's slightly different scenario, because all we had on the opening was a lot of chop, and this one, this first presented fair value gap, is not as obvious because there were gaps prior to it which could have faked everybody out. Didn't really get a sweep the other way, but we did get a dive down there. That is a balanced price range, so that could have dropped. Didn't work that way. So there were potential there in all this chop to get a couple of losses or a loss. But then when this popped up again near the macro time, gives you another massive pump up there. Let's just see for curiosity where that high was, see if that relates to anything from the previous day. And that's taken the Asia high there, look. Below the central bank dealing range, but it's taken the Asia high. So again, that would have been a plausible target. So would the London high. So anywhere between there, anywhere there or up to there would have been a good place to exit if you did pick up on that trade. And that again could have been, let's say we got in there after confirmation. Stop loss, we're still being in the same place. Risk to reward is king, never forget that. So that was potentially to London high, which would have been there. That was a 1-2 just shy of 3. And then if you'd had a runner go in, obviously did trail back and then go again, but that would have been potentially a 1-2 5.5. So again, you could have taken off, 80% there, put your stop to break even and just let that run and run. Once it's hit that, it's obviously, rejected from there. So, you'd have got out somewhere in that neighborhood. Okay, hope that helps. That's the first little look at properly at the first presented fair value gap, and one of the key aspects of how I trade the New York Open. The chart is set up purely for Vantage and some indicators I use. Just to clarify it, because it does seem to confuse people, the only reason that is on there is I can't trade without it. It's got to be there for me because it gives me the session times. Time is a very important part of picking the setups that are sort of high probability, Okay guys, hope that helps.